Global equity and bond markets both made positive returns in the fourth quarter of 2023, as several data points across the US and Euro area pointed to lower year-on-year inflation levels. In terms of major equity market performance in local currency, Japan led the way in returns last year, closely followed by the US and then Europe. So let's start this year by looking at what our key themes are for 2024. Well, they can be summarised as the 3 Bs: bonds, broadening returns and balanced portfolios. So let's start with bonds. After a period of price dysfunction, bonds should act like bonds once again this year, with investors being appropriately compensated with a yield return. And if we do see a harder landing on recession than expected, then investors may see a capital return opportunity also. So secondly, broadening returns. 2023 saw a relative narrow corridor of stocks that provided a return. In 2024, we expect to see growth asset returns spread over a wider regional markets. And finally, balance is key. Uncertainties still lie ahead economically and geopolitically, so maintaining a balanced portfolio of different asset classes is crucial for the year ahead. So now let's have a look back over the key economic headlines of Q4 and last year. The US remains the driving force of the global economy, and the year-on-year consumer price index, which includes food and energy costs, fell to 3.1% in November. Equally, both the Euro area and UK year-on-year inflation also fell markedly at 2.4% and 3.9% respectively. Now, this data suggests to markets that interest rates might now be at a peak level, with some participants now even expecting a cut to come as soon as March this year in interest rates. Whilst the UK Office for Budget Responsibility forecasts a sluggish 0.7% GDP rise for this year, valuations for UK equities continue to look attractive at 15% below their long-term average. However, it's also worth noting that over half the world's population goes to the polls this year, making it the biggest election year in history, keeping the potential for geopolitical risk firmly in play. So let's move to growth assets, and it was a strong final quarter of the year for US equities, reflecting the revised outlook for US rate policy. The fourth quarter earnings season starts in January, and analysts expect modest growth with consensus estimates for 2.4% earnings growth across the major US companies. UK equities rose over the quarter, albeit there was a clear difference between its large cap focus index and mid cap focus index, with the latter performing relatively strongly. The UK's comparative underperformance to other indices was not helped by the prospect of lower commodity prices and earnings deterioration in key sectors such as energy and healthcare. Europe was helped by Eurozone inflation dropping to 2.4%. Markets are pricing in up to 6 rate cuts by the ECB for 2024, providing a clear potential incentive for investors. Q4 was another strong quarter for Japanese equities, and this finished a strong year. Of particular note was Japan's decision to incentivize listed companies to boost valuations and earnings, with a possibility of delisting for firms that fail to show efficient capital allocation. Turning to factor performance, the growth and the quality factors were the standout performers over the fourth quarter and also the year as a whole. In comparison, it was value that was a relative laggard over the last 12 months and the final quarter of the year. Given the strong performance from the growth factor, this reflected positively in ESG stocks over the year, and they ended 2023 in a positive fashion. Turning to defensive assets, towards the end of the year, data showed a clear downtrend in year-on-year inflation, and this helped lift the broader bond index of government and corporate debt for the quarter, particularly helping portfolios that had greater duration or interest rate sensitivity. UK gilts also benefited from an uplift in prices and fears of a recession in the UK, with consumers feeling the brunt of higher interest rates more than their US counterparts. So in summary, 2023 finished the year in a very positive way, and there was in fact a Santa Claus rally in the US. This has put US valuations at a particularly high level and prone to any vulnerability in a fall in corporate earnings. So this comes back to the final B of our 3 Bs, that keeping a balanced portfolio in the first part of 2024 is crucial as we move through the first part of the earnings season.